three fundamental pillars. The first one is this idea of asymmetry. It's important for us not to risk one to make run, but rather risk one to say make 5 and above. It's about the prepping, it's about the playbooking, it's about the back testing, forward testing. Like, understand what works and what doesn't. You need to double down on what happens off the desk. It's not what happens on the desk that's going to generate extra P&L. It means get 3 samples of 30 trades, put it together and look at your equity curve. A more tangible piece of advice: don't trade alone. Stop trading alone. Seriously, trade in a team. It is possibly the most liberating thing you can do for both your psychology and your performance. The final important element is profit doesn't happen on the desk. Profit happens with what you do off the desk.
Okay, welcome back to the Trading Battle weekly interview series. I'm your host, Steve Ruffley. Today's guest is Dylan Maltman. He's not only a trader, he's built a high-performance fund from the ground up and doing it his way. He's the co-founder of Apex Capital Management. Since launching Apex, Dylan has attracted over 20 million fund assets through his strategy Athena in under 6 weeks. Following his breakout success of his firm Prop Desk, the Athena strategy is designed for liquid, highly asymmetric returns through participation across US equities, commodities, FX, CME related futures. Before co-founding Apex, Dylan gained experience across both the sell side and the buy side trading sectors, where he developed a deep understanding of financial products, strategy, and institutional grade risk management. An impressive CV. I'm going to start as always, Dylan. Okay, all us traders have a story. How did you get started? What was your into trading?
Steve, great to be here, first and foremost. My start into trading is quite simple, actually. There was a film that came out somewhere in the 2000s called Limitless with Bradley Cooper. Phenomenal film. Recommend you watch it. For those who haven't seen it, in essence, it's about this kind of deadbeat guy living in New York, I believe it is. And having lived there, he's a writer, and his life's not really going anywhere. His girlfriend dumps him. It's a really bad situation. He ends up taking this pill called NZT 48, I believe it's called, and then he, in essence, turns his whole life around. And a part of that journey where he turns his life around is he actually becomes a prop trader. And the idea of, being in a market that's somewhat idiosyncratic from general capitalism, kind of trading sort of exists outside of what's typically considered like a normal business, fascinated me. And then obviously when you get into trading and you learn a bit more about it, you kind of learn that it attracts the best and brightest in the space. It's the best game in the world, so to speak. As soon as I started to grasp those concepts in conjunction with solving problems every day, that was my entry.
So how was your first introduction into actual trading? Did you start on the trading floor, or did you trade for yourself? What was the kind of, when's the first time you pressed the button?
I see. So if we actually take 1 or 2 steps back, when I was in high school, we had a fund manager come visit our school. They had a talk. It was brilliant. I'd watched this movie a couple of years before, and I thought to myself, this is a great opportunity. So being a typical 18-year-old, I went up to the fund manager and I said, okay, I want to trade for you. What does it take? Fund manager in return said, look, go get your degree and maybe we can have a chat afterwards. Like you're too young. You're still in your kind of grade 12 year. And again, being a typical 18-year-old, I said, no, look, I want to trade for you right now. What's it going to take? Full confidence, complete dismissal of kind of emotional quotient there. And then they kind of said, look, it's going to be school holidays soon. I think it was the week after. And they said, if you're in the office at Monday at 5 a.m. and you sweep the floors and make the coffee for everyone, we'll teach you how to trade. And I actually arrived. When I arrived, they were surprised to see me. I didn't think they'd actually be there, or I'd actually be there, but I was. And that was my first original entry into the space, kind of following that.
Okay, well, that's interesting. That's I love those kind of stories because I think a lot of people forget that it's not just what you know, it's who you know and how you're going to put yourself out there. There are always opportunities in life, and not just trading. So that's a great story. So as you got started as a trader, I mean, I started myself in a relatively similar way. I was on the kind of floors at an early age. So what was your experience of a trader to start with? Again, you obviously seem a very confident guy. Was it straight, full size, sky's the limit, or you're more kind of, risk averse? What was your kind of style, and what did you learn in those early days?
Yeah, I wish it was closer to Limitless where I took a pill and I was just amazing at everything I did and I can manage, max risk. It definitely
Sure.
was not that, Steve. It took a while for me to find my groove actually. We started out trading kind of swing crypto portfolios. It was more of a
Okay.
proprietary trading firm than a hedge fund. I don't actually know if they had client capital. I don't think they did. But that's how I started. But that said, I got exposure to see how the more quantity intraday guys traded as well at the time. I then began, give or take, a 4-year process of really finding where Dylan's trading style is, and subsequently Apex's trading style as well. The initial years were very much swing orientated, 15 minutes, not taking huge risk at all. I've never blown a trading account. It's just something I've never wanted to do. I'm not a very risk on kind of guy typically. But then as those years developed, we then kind of started refining that IP to take on a little bit more risk when it's appropriate. So it was a long process to kind of find my groove there, but it was never a, max risk, just got here, everything works, and I'm the best. It was very much, learning what worked for me within those kind of initial years.
Yeah, but I think from my experience of managing, other traders and being in that kind of environment, people do move at their own pace, and you might get the odd one guy who just gets it and everything works. But for the rest of us, the reality is, isn't it? You have to, as you say, learn your groove, find your place in the market, find the products that work for you, the style. So, is there any kind of, I guess it's always great when you meet traders who've kind of started out and gone to do the big things you've done. Is there any kind of thing for our listeners, like the retail traders, that you would kind of pass on and say, from my experience, this is a key tip or this is a key downfall? What would you tell guys just starting out?
Yeah, I think it's really important to understand the sector you're in. I think that's the first thing. So typically we find a lot of guys start out trading CFDs, nothing wrong with trading CFDs. But the first like real major component to understand is that CFDs aren't designed for, your really short time frame, low time frame intraday strategies, just from like a cost basis. And if you learn how the sector works. So I'd say know what product you're trading, know what you want to trade in terms of strategy. I'd also say it's really, really important to get into the nuances of what type of trading you want to be good at, understand the logic of that. Like swing trading fundamentally is different from momentum trading, which is fundamentally different from scalping. Those are all very different strategies and all have very different rules associated with them. So get to know that. I'd say the final important element um, is profit doesn't happen on the desk. Profit happens with what you do off the desk. It's about the prepping. It's about the playbooking. It's about the back testing, the forward testing. Like understand what works and what doesn't. It's not about just arriving to the chart and making something up and going, oh, cool, I made money today.
Yeah, it's interesting. That's some good insights. And obviously, you're quite different in your fund because I mean, you're talking about intraday trading. That's
Mhm.
not something I've come across too often.
Mm.
Can you explain a bit more about your reasoning for the intraday trading style? Because obviously, I'm an intraday trader myself, short time frame. So I'm really interested to see how you scale that up and make that into a fund.
Yeah, absolutely. So within a fund setting, the intraday sector is something new to kind of the more sophisticated portfolio side, right? So typically, most modern portfolios are built on something called a 60-20-20 split in our experience. So that just takes the form of 60% equities, 20% bonds, and then 20% alternatives. We fall into that small alternatives bucket. Now, what is an alternative? Right. An alternative, in essence, is just any form of fund or source of alpha generation that isn't correlated to your traditional equity markets because of things like leverage and because of the increase in the amount of traders that are participating in these markets. When everything goes up, everything tends to go up together. When everything goes down, everything tends to go down together. Now what does that do? If I'm an allocator and I'm watching my 60-40, so 60% equities, 40% bonds portfolio, for example, and everything's going up at the same time and going down at the same time, I'm going to have a wild ride. I'm not going to be able to sleep at night. Whereas if you include that 20% alternative section, you can really smooth out those returns substantially. So it's all about smoothing out returns and getting uncorrelated alpha. Now, Where does intraday come into this? Well, here are the benefits. The first is that with an intraday strategy, and Steve, you'll know this best, it's a liquid strategy. If you're trading intraday, you can deposit, withdraw overnight. It's a very, very simple process. A lot of your long, short equity strategies tend to not have that kind of liquidity. Once you're in for a quarter or a year, and you can't add or remove any size from that, typically. So the first part is liquidity. The second part is the uncorrelated nature of returns, which we spoke about. When you're trading in and out, within say a 6-minute time frame, those returns aren't going to be anywhere near correlated to what the broader market is doing. The final element is that it's differentiated, which kind of touches on the uncorrelated returns part, but also you don't want to have, 10 guys in one portfolio, all of which are doing the same thing, just with a slightly different approach. So that's typically where intraday is now jumping into your more modern and sophisticated portfolios.
Okay, I guess it kind of makes sense, and obviously, I guess with the injection of Donald Trump and his, his effect on the markets, the fundamental side has really blown up. Which I guess, in my environment, how I grew up was everything was an opportunity. I know we talk about, kind of a lot of traders are very much focused on the downside, and and risk as quite a negative thing. When big events happen and you see these large directional moves, that's something you can jump on. So from an intraday trader or a fund that's based that way, there must be huge opportunities. I mean, do you see that? Do you see your guys being able to capitalize on news? How do you brief them? What do they look at? What's the kind of preparation you've given your traders in order to capitalize on these? Not, I mean, it's not new. We've experienced these kind of events when Trump was president, the previous time.
Mm,
But I think they're definitely more exaggerated now. So I think as an intraday trader, it's much more risk on
mm.
when he's talking. So I mean, how do you brief your guys on that? What's your kind of play for that?
Yeah, it's a good question. And the way that we've formulated and prepared our guys to take advantage of that unexpected level of volatility and outsized volatility at that really stems from how we created the fund itself. So we've currently got 4 traders, each of them trades 2 strategies each. Each of them have completely segregated strategies that fit their personalities and their trading style and experience. But all of it is for the most part built on 3 fundamental pillars. The first one is this idea of asymmetry. It's important for us not to risk one to make one, but rather risk one to say make 5 and above. That's the first element of importance. The second element of important for us is what we call risk management. So on top of these asymmetric strategies, we build a boutique risk model that is specific to that actual strategy itself, if that makes sense. Again, as we touched on earlier, momentum strategies are subject to different risks than, say, a scalping strategy or a swing strategy, for example, right? So that's really important. On top of that, the third pillar is what we call this idea of idiosyncratic edge. So, an edge that stems from the market itself that we're trading that isn't typically available in any other market. So, for us on the futures side, that is things like order flow, it's things like trading central limit order book dynamics, things like that. So, on top of that, that's where the strategies build their stuff. Our traders build their strategies. Now, in terms of understanding how our guys are able to take advantage of this with the level of volatility, it's actually quite simple. We teach our traders how to get involved in opportunities in multiple different ways. So it's not a set, this is how you trade. It's very much, here's the opportunity set. You've got some form of directional edge here, and that will be, again, some kind of fundamental or some kind of quantitative edge. Here's 5 different ways for you to get involved. Pick the one that's going to give you the most amount of upside with the least amount of downside risk, if that makes any sense.
Yeah, absolutely, absolutely. So, I mean, there's two key things I pick up there. So, I guess the first one's personality. So, are your traders experienced, or do you give them the experience? And obviously, personality. I don't think people realize when you're a trader. Nobody's, I don't think, born a trader. You have to be kind of, brought into some sort of structure. But obviously, some traders will be much more, aggressive and then naturally risk adverse. Doesn't mean they can't make money. It's just different kind of, different people have different, kind of natural approaches to risk, danger, money, all that kind of stuff. So I guess the question is, from a risk perspective, how do you manage that? Is it kind of an automated system, or do you have a risk team? Because obviously different personalities. I know you have kind of set strategies, you say, but altogether, how do you manage that kind of melting pot of trading talent? You know, what's the kind of the back end doing to make sure that profits maximized, but obviously risk is, you know, kind of within tolerable limits?
Mm. It's a good question, Steve. You can tell that you've been on the floor. You know what the questions to ask are. So there's a lot in there. I think let's unpack that for a second. So firstly, we started off the question talking about how different traders have got different levels of experience and different comfort levels, right? I think what's a really important element to mention is humans naturally make very bad traders based off something called heuristics, right? Humans have this natural tendency to let losers run and cut their winners short, which is not ideal, as you know. So, first and foremost, when we get a trader on board, our first priority, if they're experienced or not, is to assess their current set of heuristics. Have their brains adjusted to the idea of I need to cut my losers quickly and let my winners run? We've got methods in which that we do that, but that's kind of the first goal for us. That's not good enough in terms of risk management, as I'm sure you know. This is not a trust me, bro business, if you know what I mean. So the way that we overcome that is through tech enforced risk limits. So again, there's a level of trust that we give each trader that we model risk for. So let's call that about 1.2%. That's currently what our kind of max daily loss is. Each portfolio can only lose as much as 1.2% a day, at which stage the system kicks them out and locks their trading terminal and everything's taken back to cash and they're done. You don't want to be in that position. You don't want, someone giving you a tap on the shoulder and said, "Come, mate, let's go for a coffee. Let's chat about what."
Let's talk about it. Yeah,
Yeah. It's not a good
I've been there,
situation.
mate. I've been there both sides. Yeah,
Yeah, yeah, exactly. So have I.
yeah.
And it's not a fun conversation. You want to have that kind of ability to discipline yourself and get off the desk kind of way before you hit that level, right? That said, we model risk such that everything is a-okay if we do hit those limits. I think in conjunction with that, what we also have, we spoke about the non-correlated nature of intraday. My returns typically aren't going to be correlated to yours, for example, Steve, right? So that gives an added benefit in terms of risk management, that it is extremely unlikely that everyone is going to have this like second standard deviation problem on the same day, if they have it at all. So that's typically how we manage risk on our desk.
Okay, yeah, it makes perfect sense. Makes perfect sense. So, I mean, I guess let's go to the other side then. I mean, you know, you said that you raised 20 million in a very short period of time. What's the kind of process for raising funds for something like this? Because I mean, I guess it is quite niche.
Yeah. I have to be specific on the wording here. Obviously, the CFTC and NFA rules are very specific. So we've got 20 million in interest. So we haven't raised 20 million. Very important part. Yeah, exactly. So this is just an indication of interest so far from these
Got you.
individuals. Yeah, so the raising process is really interesting. So the way that we decided to tackle it, or get this indication of interest rather, is you'll typically find that when a proprietary trading firm is investigating providing client exposure, right? Because that's really how this all started. We started off as a proprietary trading firm, and then we had a number of sophisticated clients say, look, I don't know if you realize this, but your strategy has got a ton of benefits for your insurance companies and sophisticated portfolios that mainly use margin. It's a very demanding space in that sense. And then we said, all right, well, look, if there is scope for it, we don't have infinite scalability in the strategy, but sure, let's investigate it. And that's where that 20 million came from. As far as how we did that, it really was as simple as saying, look, you guys know about what we do. Here is a general sense of how we perform. It's not exactly how we perform, just like this is kind of the benchmarks that we aim to target every year. If this in, say this style of product with this style of fee structure, with this kind of lockup makes sense for you, let us know. And that's where that kind of number came from. A really interesting part, though, when it comes to raising capital is obviously this discussion of track record. That's
Yep.
always the first kind of pillar, right? You go to any firm, you go to any fund, they're going to ask you, look, can you show me your track record? Show me your
Yep.
kind of references. And that's been a really interesting process for us as well, because typically your track record is linked to a particular strategy. So again, you can trade strategy one for 5 years, but you create a new strategy, go to a new client, and then that track record's no longer valid, right? It's a new
Right.
strategy, different market. It's not the same thing. So there's always this chicken and egg element that's challenging to overcome. My advice for anyone who is going down that route, again, just indication of interest, is raise on what we call a waiting list or an indication of interest list. Why is this important? Well, you can create a backlog of potential investors if you decide to go that route later on, firstly. And secondly, you also overcome this challenge where no one wants to be more than, say, 15 to maximum 20% of whatever your fund AUM is, right? So if I've got, say, $10 million, the maximum ticket I can get on top of that is only 2 million. That's a really difficult game to play, especially when you realize how big the ticket sizes get in the sector. 2 million is nothing. 10 million is nothing. Only once you start breaching 100 million is that a typical ticket size. So that would be my advice. I wouldn't go the traditional route of going, look, let's get a fund incorporated. Doesn't matter who actually wants the thing. Let's just get it up and get started. And you're stuck with all of these fees. I'd highly recommend go the other route where you maybe do your due diligence on the market first, understand what these clients want, what they're sensitive to, what they're not, and then take it from there.
Okay, that's interesting. So obviously, as you say, your strategies kind of change. I mean, do they change specific to the markets that you apply them to, or can they be applied to every market? Obviously, you have a plan as to kind of how you're going forward, for the next 3, 6, 12 months. How do you allocate a trade or a strategy into a product? I mean, what's the kind of, I guess, the background that you're looking for? What kind of technicals, fundamentals, what's kind of
Mm.
driving the decision to where a strategy is best implemented with which trader. So the kind of bigger
Yeah.
picture, I guess, without no IP, you don't have to give any IP away. Just trying to think about how you think about how this runs.
Yeah, and it's a great question because I mean we've got the capability to run several different types of products, right? So
Mm,
so if I'm understanding you correctly, Steve, you're asking how do you select which trader goes into each specific product or strategy that you're
exactly.
wanting to trade, and
Exactly.
it's a good question. To date, it's been again very idiosyncratic. So we've got again our four traders, each of them have just shown that they have a willingness to learn and a passion for intradays specifically. They've obviously gravitated towards individual markets for various purposes, and we've got IP to support them in that. So I'll give some IP here. This isn't news to anybody, but in case it is, you're welcome. If you look at, say, the Nasdaq typically has got a propensity to break out more than mean revert, right? So the traders that have, maybe a bias or a potency in their edge with regards to breakout strategies will typically say, look, let's, give you more exposure to NQ than everybody else. And one of our traders, for example, is a phenomenal swing FX trader intraday. As we know, FX tends to kind of mean revert more so than what it breaks out on average. Obviously, there's exceptions. So to him, we'll say, look, we've got IP to support you in the kind of mean reversion game. Let's maybe increase your allocation towards FX and commodities like let's use crude oil. Crude oil, can mean revert and break out fairly equally, but you get a good blend of both. So then we'll give him a higher allocation there. It really is just about demonstrating where your core competencies are and finding the instruments that match that in the best way and shape possible.
So, what are other kind of markets? And obviously, there's a lot of talk about, crypto again is back, in the news more than ever. I mean, obviously, Bitcoin, record highs recently. Do you guys have much exposure to that? Do you dabble in stable coins? We've had other, kind of traders on that are big into this. Personally, never traded Bitcoin or coins, so it's not something I've any experience in at all. But is that something you guys have got exposure on?
We've got deep connections within the crypto space. A number of crypto market makers and prop firms have asked, look, can we allocate to you if you have a crypto product? There's interest there. I think for right now, it's important for us to double down on our current product just because that's where the focus is, this kind of active trading liquid investment vehicle for your more TradFi guys. That being said, I think within the next year and a half, maybe 2 years, we'll have some kind of crypto exposure. We've got the talent. My co-founder, Jonathan, is a phenomenal crypto trader, one of the best, if not the best I've seen in the business, to be honest with you. And I think his talent would be wasted if we didn't actually do something in the crypto space at some stage.
Yeah, for sure. Yeah.
So it's on the horizon for us, but for right now, our focus is just placed on the kind of intraday product fund.
So, what are your kind of plans then going forward? I mean, like you said, there's a limited availability to scale. You say, but I mean, is that as you said, 100 million cap or more? What's your plan to kind of grow? Is it more traders, more products, more strategies? Where do you see this in 5 years' time?
Mm. So, stemming back to why we started Apex in the first place, when I worked on the sell side, I had exposure to a number of your local and international hedge funds. And obviously, if we're providing liquidity to them, we get to see what their P&L is, in essence. And what fascinated me at the time is that you've got these massive hedge funds trading a ton of capital, but very, very, very few of them are actually generating asymmetric returns. And their volatility is all over the show. 1 month they're up, 1 month they're down, and typically they're risking one to make 1.1, 1.2. It just doesn't make a lot of sense. It just feels like gambling, to be honest. And something just didn't sit right with me when I saw that. You get this idea of what a hedge fund should be. You're paying someone, a 2 and 20 split to generate returns fairly consistently in a non-correlated fashion. Why are these guys getting these terrible, terrible volatility curves? Sorry, equity curves and high levels of volatility. And that's in essence where the idea of Apex was born, which is generating actual asymmetric risk adjusted returns on a kind of high investment metric basis, right? Not having a Sharpe ratio of 1, but actually having a substantially higher Sharpe ratio of 3, if not higher. That's our goal. So in the future, what happens when the strategy reaches its scalability? Well, new products. We've got a ton of ideas and a ton of IP on how we can generate these strategies that, yes, maybe somewhat constrained in terms of how big they can get, but we can create multiple of them, right? So we can do something similar in treasuries. We can do something similar in crypto. We can do something similar in, for example, tokenized futures, right? There's now tokenized gold, which moves very similarly to the gold futures, for example. So there's another kind of added liquidity benefit there. Really doubling down on being the go-to company for your extremely high quality alternative strategies across the board. That's the future for us.
Yeah, that's good. I mean, it's all really kind of interesting stuff. I mean, again, when you speak to different guys, the work for the likes of Goldman's and that kind of stuff. It is a scalability issue, and I guess the biggest thing that I've kind of come across in my own trading, and I guess definitely guys I've spoke to that that trade for banks, is that psychological edge in being able to scale up. So that
Mm.
kind of when you're talking about P&L shifts in not thousands but millions. Is that something you've experienced, or is that something your guys have experienced? It's always interesting, I guess, from where we are right now, talking, on the trading battle, trying to give that insight to retail that might be struggling getting, over to $100 a day swing, getting to that
Mm.
thousand. And it's kind of, how the guys get from, tens of thousands to hundreds of thousands to millions. I mean, what's
Mm.
your kind of view from your own trading experience and your guys of that psychological edge? Because we know we've been trading isn't easy, but really is the click of a button. But the majority of the difficult things, it is a mental game. From your own
Mm.
experience and your own guys, what would you think you could bring, to the guys that are just watching, saying, "Well, how do I scale up? How do I really attack that psychological edge? What can a pro like yourself teach us?"
Great question. And I think we can add a lot of value on this. So let's double down on what we give here. I think let's talk about scalability first. Okay, how do you scale up your trading account to the point where you can increase the amount of volatility that you can give your account without blowing up? The first really important piece of information, just coming back to what we spoke about earlier, you need to double down on what happens off the desk. It's not what happens on the desk that's going to generate extra P&L. Now, what does this mean? It means, get 3 samples of 30 trades on, one of the backtesting softwares out there, put it together and look at your equity curve, right? Define what your expected value is. Okay. If you don't know what expected value is, it's a metric of how you measure the average performance of a trading strategy over an infinite amount of time. There's 2 components to that. Really get into expected value and understand each of those 2 components. What I'd also say is have a very high standard for what your expected value should be. I typically see traders have an expected value of sub 1. On our desk, we only deploy strategies at minimum with an expected value below 2. All of our current traders typically have expected values of 4 and above. You need to get onto that level as quickly as possible. Why? Number one, your trading strategy is going to perform excellently. What does that do to your psychology? It's going to go up. You're going to be fine. You're not going to care about that small loss that you took. It's not going to bother you at all, right? Secondly, why do you want to have an expected value so high? Well, here's the thing. Typically, when you've got high expected value strategies, you've got a strategy that doesn't risk one to make one or two or three. It's one to make five, for example, with a high hit rate. What that means is that you're able to risk very, very little to make quite a lot at the end of the day, right? So again, what does that do? It means your returns increase, and it means that you don't care about the one or two losses that you do take. It's not the end of the world. I would also say it is very rare in the beginning stages where you want to learn to risk up on the trades themselves, risk more per trade. Typically, you want to, in the early stages, the lowest hanging fruit to increase your performance and scale up is actually to decrease your losses. That was really important for us right in the beginning. Do I need to have a full size stop taken out on this? Do I need to lose the full $1,000, for example, on this trade? 9 out of 10 times, the answer is no. You don't actually need to. You can have a standard, say, trade size or kind of stop size, let's call that 50 ticks. Let's say within that 50 ticks, you're losing $1,000. Typically, you don't often actually have to lose all of it. You can say, look, if this goes 25 ticks in the wrong direction, or your maximum adverse excursion is a measure of this. You look it up if you're watching this. If price goes 25 ticks against me, so let's call that half your stop. How often after I get to that point does this actually result in a winning trade? The answer most of the time with our observations is slim, like 10%. And when it does win, it is a shocking winner. It is a very difficult trade to sit through. It's psychologically pressuring to sit through it. Whereas for us, right in the beginning, we said, look, if I've only got a 10% chance of winning this at this point, why don't I just move my stop there?
Yep.
I've then only lost half my stop for the day. I can take another trade somewhere else and maybe make that back plan some. Do you see what I'm saying?
Yep. That's exactly what
So
you're
that
saying. Yep.
Yeah, so that's really important. I'd say the final thing of how do you scale up is once you've gotten a high expected value strategy, and truly high, you've not curve fitted, over 30 trades or 100 trades, you've actually tested this thing over a substantial sample set. I would then say be acutely aware of volatility drag. What is volatility drag? Everyone actually knows about this. This is just a fancy word for it. Volatility drag, if I lose 50% of my portfolio, Steve, how much is it going to take me to get from that now 50% back to where I was? You have to double it, 100%. So that idea of going, okay, if I lose 1% of my portfolio, I need about 1% to make it back. Not a
Yep.
big deal. Can just keep going. But if I lose 50%, I now need to double my return or double my portfolio to get back there. That idea is called volatility drag. In our experience, you don't want to be in a position where you're risking any max drawdown more than 15% if you're extremely aggressive. As soon as you start breaching 15%, you're then starting to get into volatility drag realm where you're basically just diluting your performance based on the mass, right? My advice would be get to high expected value. And as soon as you get there, if you really want to risk up and size up, be acutely aware of that 15%. Oh, and one more thing, consider scaling in. So again, if I've got a strategy that I know wins 70% of the time, and let's say it wins 5-1 on average, if I get to 1R on my core position, so I get in, I'm at 1R, I move my stop to break even, for example, I'm
Yep.
now risk-free on the trade. All I've got is open P&L. If I've got statistics to show me, okay, look, when I get to 1R on average, I win my trades to the full 5R. Again, let's just use 70% of the time. Scale in again. Add
Sure.
more risk in. Your
Go
risk
again. Yeah.
stays
Yeah.
the same in terms of your downside. That doesn't change. What does change is now your upside becomes exponential. Like again, Steve, if you get in with a core position and you add 3 or 4 times, what was a 1 to 5R is actually now 1 to 5R times 3 or 5, depending on how you scale
Sure.
it and when the size that you get in. That's where
Okay.
real asymmetry comes in. So that would be my advice. Double down on those basics that actually happen off of the desk and get into the maths of what you're doing.
That's really interesting because I guess a lot of traders just don't want to put that effort in, and that's what you're going to find. I mean, is the kind of products you use, or is that your own kind of systems you have in place, or something you taught yourself? Because I mean, it's not something that your average retail trader would just kind of maybe they Google it, use my FX book at a very basic level, I guess. So I mean,
Yeah.
how did you come about that? Was it something you were taught, or did you come up with? I mean, it's clever stuff. I mean, it's
Yeah, yeah, I appreciate that, Steve. Thank you. To be honest with you, I was just so bad in the beginning. Like it was a very difficult and time-consuming process to actually just find edge. And even
yeah,
asking yourself eventually, what is edge? What is my edge? To get to that
absolutely
point where you start asking those questions is typically the turning point for where you stop trading and you go back to the drawing board and look at like, okay, if I was to design something with a stable edge, how would I make that?
sure,
Um, I also will acknowledge that although we've done a ton of research, I mean, Apex is a close to decade-long working hypothesis now. That this has been something that's been growing in the works for a while. Cumulatively, we have had a lot of help from a lot of your kind of more mature proprietary trading firms and hedge funds. With that said, I have to give a little shout out, if you will, to Ryan at SMB. He put us in the right direction. He didn't give us any like kind of this is what you need to know, but he definitely
sure,
raised the standard of what we knew was possible. So the guys at SMB Capital are phenomenal, great resource. Have a look at them. In terms of scalability in the business side, Andy Koshner from Koshner Trading Group, they're a partner with SMB. They've been phenomenal. We've had some talks with them. It really has been the ability to look at what's possible out there, the guys that have been doing it for much longer than you, and then going back to the drawing board and going, okay, I thought like 50% or 60% at a 2-to-1 risk reward was really good. I now know that it's actually possible to get like a 65% with 30-to-1
yeah.
consistently. Like that now is a thing. Okay, so let's scrap everything that we did and start again. Getting to that point of raising the standard and speaking to guys that have been doing it for much longer than you, I think is what's enabled us to ask these good questions and come to these conclusions.
Yeah, I mean that's definitely a key thing. I guess for you guys out there, the retail guys, finding a mentor or just somebody who's kind of been there, done there, and that's really again why I do these interviews. I love speaking to traders, love speaking to people who've gone on their own trading journey, as we all do. It isn't all sunshine and rainbows, lots of ups and downs. But
Mm.
some things, it's just like even that tiny little piece of knowledge or that view that you can ask someone or someone will just point you in the right direction or ballpark, and that could be enough to send you down the right kind of directional route where you can find your own answers. Because at the end of the day, that's what it's all about: finding your own answers and finding your own trading style and what works for you. And I think that's where a lot of retail traders fail because they get almost drawn into this world where they read every book, watch every webinar, go to every seminar. All of a sudden, it'll just click, and somebody will tell them how to trade. You have to find your own way within the market.
Yeah,
I mean, it's
yeah,
really, really
100%.
interesting. Yeah, it's really interesting what you said and what you do. I really like this kind of very methodical, maths-based approach to kind of to the risk and knowing your numbers inside and out, and that numbers giving you the confidence to keep going. That's really interesting. That's really interesting stuff. I mean, is there
Mm.
anything kind of that's come up in this conversation or anything that you want to kind of just drop in that you might think would be useful to the listeners? Again, I try and keep it organic. Guys like us, we could probably speak all day if we wanted, but I know there's a finite time that we can. Is there anything that you'd like just to kind of say to the listeners, to the guys out there aspiring to be maybe the next level up, to become pros, to work for funds like yourself? I mean, what's the kind of what you got? What
Yeah,
you got?
yeah, absolutely, absolutely. Um, Trading can be a very lonely process, right? Especially when you don't have the IP, people don't understand what you do, and if you're a guy, a lot of guys, myself included, are proud of their career. You want to build something, you want to have a legacy. Now, again, you're swimming an uphill battle being in retail. Like that's
Sure.
just the kind of long and short of
The
it.
reality.
That's the reality. But again, the reality on the other side is we started off as retail. Like it is absolutely possible. What I would put forward though is that you don't have to beat yourself up along the process. Like waking up in the middle of the night and going like, why am I not profitable? Why am I not getting this? Is it me? Am I not meant for this? You are. This is just tough. It is tough for everybody. But
Yeah.
again, it's almost like the graph of latent potential. Right in the beginning, you're going to be making these very, very basic mistakes and learning basic lessons. Your learning curve is not linear, it is absolutely exponential. And once you break through that latent potential linear line, everything becomes easy. And it actually does become easy once you've got the fundamentals in. A more tangible piece of advice: don't trade alone. Stop trading alone. Seriously, trade in a team. It is possibly the most liberating thing you can do for both your psychology and your performance. Why? Number one, if you've got a trading account of $100, for example, and you divide that $100 between four guys at $25 each, your risk now doesn't really impact the P&L curve, right? You can go to bed after having a losing day and going, yeah, like I lost and that sucks, but I've also got my three buddies who are also very good that I work with every day who had my back. Maybe I lost 1R or 2R, but they cumulatively came back with 4R or 6R or more, ideally more than that, but they've kind of hedged out my losses, right? That's the first thing. Psychology goes up. The second thing is when you're able to trade with people, humans are very good at dynamically adjusting to problems. That's the way the brain is wired, right? You can put us in the majority of situations, and 80% of the time we'll get it right most of the time, right? The brain is not designed to get everything right 100% of the time. You will make mistakes. How do you overcome that? Well, you get other brains to look over the same problem sets as you to validate your thinking. You would be surprised how many times, we arrive to the desk as a team. I've got a view, and, the rest of the team has got a completely different view. We're looking short instead of long. And I go, guys, if we flip here, so let's say, guys, I know you're all looking short, but if we flip here, here's my thesis. Get out of your positions and flip long with me. And then the team goes, oh, jeepers. Okay, we didn't see that. Really good idea to hedge that position. And, that was actually one of our biggest days. Just having that ability to go, dude, take a look at this. You may want to have this extra piece of insight. So trade with the team. And then the final thing is, I can't emphasize this enough. The profitability happens off the desk. It happens on the Excel spreadsheets. It happens on the phone calls to the mentors, and like an actual mentor, not like a guy who's selling a kind of BS course out there, like an actual guy who does it for a living, right? Like there's so many scammers out there, unfortunately. You want the guys that have been in the pit, like you want the guys who have actually been there.
Yeah, that's really interesting because yeah, back in my days, for myself on the floor, it kind of worked two ways really because it was on the floor. You're exactly right. That kind of, although everyone was an individual trader, that kind of group mentality, people sharing information was great. I mean, I think the big thing for me was, especially being in the city, was the kind of external nightlife, kind of
Yeah,
life, all the kind of things that go with that. I think
mm,
sometimes for me, you have to balance the kind of introvert and extrovert nature of
yeah,
what people think a trader is and what a trader actually is. And that, sometimes, you have to be alone with your own thoughts to get the best out of yourself. But I think you're exactly right. At a point in your career, you do have to obviously, I think, speak to somebody else. I don't necessarily know if it's possible for everybody else to trade in a team or trade with other people, but you can certainly get involved, I guess, in communities and converse with the traders. So it is a real fine balance. I think you're right between the advantages of being able to discuss trades and trade with other people. That must be incredibly liberating, like you say, to have someone to have your back. But then also knowing that trading is ultimately one of the most individual things you can do. It's you against the markets. And I guess until the time where robot overlords and AI takes over, I still think humans have a massive edge in the markets. I mean, that's another good point to spin off. AI, do you use it? Do you see it in the markets? What's your view? I mean, that's got to be a
mm.
strategy going forward.
It's an interesting problem set, Steve, and I'll tell you why. So currently AI, or what we have now, is large language models, or LLMs. So, and I'm sure you know this already, but for everyone who doesn't know, an LLM in essence is a very advanced mathematical algorithm that can predict based on statistics what the next correct word is. So it's not actually smart. It just is able to predict what the next correct answer would be to the greatest degree possible. It's a phenomenal piece of tech. There's a reason that, OpenAI and those guys are doing such, large multiples at the moment. That being said, the problem with these things is that they need to be trained on something. Okay. So you go to ChatGPT. ChatGPT typically is trained on internet-based information. The problem is we know that not everything on the internet is valid. Not everything on the internet, in fact, very few things on the internet is going to generate edge for you, especially in today's markets. So how do you face that problem? Well, there are proprietary trading firms out there that have invested a ton of money into AI, and they train these things themselves on their own IP. That works too. The problem is if that AI does something wrong or loses a bunch of money, who's liable? You've spent all this money to get the thing open. It now makes a massive mistake. Hopefully you've got taken forced risk limits so that it doesn't, but let's just say it does. You're out of pocket, A, because you've spent a ton of money on it, and B, it's just lost its entire portfolio on you. So that's really important to understand. The third thing is that it's only as good as the information you trained it on. So do I think it's going to become more prevalent in the future? Absolutely. I just don't think in its current form. LLMs, I think, is just a very challenging problem set for trading specifically.
Yeah, it's interesting. Yeah, because I mean, I had a lot of experience, with guys that went into the kind of grey boxes, black boxes. But we're talking maybe 15 years plus. That's it's a whole different world now. I'm not a self-confessed techie. I don't. I'm just I'm an old school trader. But yeah, I mean You can see the allure and the kind of the problem solving kind of mindset of your tech guys going problem, market, money, put it together.
Yeah,
It's got to work.
yeah,
But yeah, it's
yeah.
interesting. I think it's definitely going to be interesting for next 5, 10 years in trading. It's going to be really interesting. I
Mm.
mean, listen, Dylan, we honestly we could talk all night because it's been some great insights. I've really enjoyed it. I mean, how can guys get in touch with you? Have you got socials? You're present. How can people get in contact with you? They want to kind of maybe chat through your ideas or look at the fund.
Yeah, absolutely. I think the best way typically is via email. I'm quite a private person.
Yeah,
So I'd say reach out to us on the Apex website. We're kind of in process of getting it redone, so we're really excited to have that launch. Other than that, we're pretty active on LinkedIn as well. Take a look at what we post on LinkedIn. Drop us a DM there. I think anyone on the team is always happy to help. Myself, John T, or any of the other guys. And yeah, I'd say those two avenues are the way to go.
yeah, sweet. I mean, I get that. Get the privacy. That's good. I mean, yeah. I mean, again, I think we've covered a lot here. There's a lot to kind of unpack there, and yeah, really kind of interesting approach to trading, and quite different from other guys that I've interviewed. It's been really interesting. I think the viewers will really enjoy this. So yeah, I guess the only thing left to do is thank you for your time, Dylan, and yeah, if you like and enjoy the trading battle interview that we've done today, just hit the like and subscribe. And I guess I'll be here next time with a new guest. And yeah, it's been great, guys. Cheers. Thanks very much. Good night.